please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Markets dance to the tunes from Bengaluru. A 500-point gain gets wiped out on the Sensex after uncertainty over government formation in Karnataka keeps investors on the edge.
And Karnataka also takes the money market on a roller coaster ride. Bonds hit their lowest level in over 30 months. The rupee also hits its lowest level in 16 months after some wild swings.
Hit by Nirav Modi and Mehul Choksi fraud case, Punjab National Bank reports a fourth quarter loss of over 13,400 crore rupees. Asset quality also takes a hit, with gross bad loans rising by over 50% quarter on quarter. Stock falls nearly 4% as it shaves off all the gains on the Nifty Bank Index. Well, those were the headlines that we were tracking through the morning, afternoon and now the evening. Hello and welcome to Markets Today Talk Back, the show where we wrap up the day's trading action for you and prepare you for tomorrow's trading action. With me is Nigel D'Souza. Hi, Nigel. Thanks
for that, Latha. Well, over the next 30 minutes, we will discuss the Karnataka elections and how they will impact our own markets. Joining us on the show to decode the impact, we have Nilesh Shah of Envision Capital, as well as technical expert Mkts Thakur. Thank you so much, gentlemen, for joining us on the show. But before we come to you, let's run you through how the markets fared in today's trading session. Latha, over to you.
Well, as we just said in the headlines, they were dancing to tunes from Bengaluru. Well, markets rose, rocketed up to near-term highs, probably highs since February, after it appeared that the BJP will cross the halfway mark. And when that wasn't to be in afternoon trades, we saw the market slide down. But it did look like after a point, the market had handed over the baton from Bengaluru to the macros. And the macros have obviously not been very favorable. We saw inflation numbers that were higher than expected and crude touching $79 today, 78.90. And that clearly has hurt the bond and the rupee markets considerably. Bond yields touched 7.9, and despite this mild recovery along with the BJP's fortunes, they've gone back to the 7.90 mark with many economists expecting rate hikes as early as June or definitely by August. And of course, the rupee, again, recovering a bit with the BJP's fortunes, but then sliding towards the 68 mark. And ultimately, it was only the global-facing sectors, you know, metals and IT, which ended the day with honors.
That's right, Latha. You know, given the kind of volatility that we saw, volumes are very high in today's trading session. The cash market volumes, even the derivatives volumes are very high. And if you were taking a look at the Nifty, well, you had to take a look at BEML. That stock was just moving around in today's trading session. One part of the street wanted the same ruling government in the center and the state, and maybe that long-awaited divestment could go ahead. So that stock corrected nearly around 10% from the high point of the day. Earnings we got today, not too great. PNB as well as Lupin, both of them were a tad bit disappointing, but there was some green. Tata Steel did well in today's trading session ahead of its numbers, and a couple of those Tata Group stocks as well did do well, but all of them didn't do well because we had a Tata Motors that hit a 52-week low. Is there value or is there a value trap out there? You know, it's gone to around 310 rupees odd. Coal India as well continues to see selling pressure. Well, Latha, if you're looking at the broader markets, Tata Steel did well, JSW Steel as well, ahead of its numbers. Tomorrow we have both those earnings that come out. SAIL as well did piggyback along. But you were making this point, Latha, yesterday about the consumption theme. HUL did well. We had, a Nestle that did well as well. Colgate today, that seems to be factoring it in, 3.5%. But if you got it wrong, Jet Airways is down 30% this month. You have Tata Global Beverages that you were talking about today. That's down 20% in a single month. So if you got it wrong, you lost a lot of money.
Not all consumption stocks, only some of them. But yes, IT metals and some of the consumption stocks were the ones that did well. And what didn't do well were the interest rate sensitives. So PSU banks, NBFCs, and of course, realty companies took the pain. Well, with that preface, let's straight away invite our experts, Nilesh Shah and Mkts Thakur. Nilesh, first to you. What are your key takeaways from the political theatre? Do you think that the markets will be positive on the note that, the BJP, if anything, has increased its, its popularity? Or, are we just barking up the wrong tree? Is the market not that terribly interested in politics, and it is macros that are taking over?
Well, you know, outcome of the state elections, I think, is just one event, which we believe has little relevance from a purely fundamental point of view. We don't believe that, you know, the elections of a single state can basically drive economic growth, or it's responsible for any kind of the macros that are there. So clearly, yes, it's important from a 24-hour or a 48-hour perspective. The only difference this time around is that the outcome of this state election is just you know, a year away from the general election, and I think a lot of people expect that this could be basically an harbinger of things to come in terms of what the potential outcome for 2019 elections could be. And during the course of these 12 months, it could set the base for political formations and various kinds of coalitions which could get stitched up, which could probably make it even a little more difficult for the ruling party to basically try and sustain its victory margin. So I think that's the kind of speculation that you know, the street has been engaging in. But we clearly believe that it has really very little relevance in terms of actual fundamentals. Clearly, I think probably maybe let a session or two go by, and we would be back again focused on the macros in terms of inflation, potential rate hikes, and most important of all, earnings for the quarter gone by and the outlook which corporate India is going to present. So clearly, our sense is that you know, it's definitely going to be fundamentals and macros which will take over the outcome of one single state election, maybe in a session or two.
No, I take your point entirely that, you know, after a day or two, the markets will forget about this event. But nevertheless, you know, we saw the rupee also recovering a goodish bit when the BJP numbers were looking like reaching towards 115 seats. And when that number, magic number, did not come, we saw the rupee also crashing. Those macros are extremely sensitive to political stability. So, you know, just as an investor, what is your takeaway? Is your takeaway that the BJP is still very much increasing its chances of staying on in the center? Or is the market takeaway that, you know, the opposition stitching up of alliances can actually make a return of BJP a little less probable than it was, say, some months ago?
Well, I think, Lata, the big difference between you know, elections in 2019 and the elections in 2014, I think a big difference is going to be that in 2014 we saw one single wave cutting across the country, cutting across all the states, irrespective of political alliances and all those kind of political equations. Clearly in 2009, it's not going to be just one single factor which will decide the outcome of the elections in 2019, but it's going to be a lot about you know, what kind of coalitions which get stitched up in individual states. So if, for example, after today's election outcome, if we saw the Congress and the JDS trying to kind of, you know, stitch a post-poll alliance and make a stake to form the government, it's quite possible that maybe as we head into 2019, you could actually see several pre-poll alliances getting formed in individual states. And obviously, when you have coalitions getting formed, it clearly implies that it's going to become very difficult for the party on the other side or on the opposite side. So I think that is basically what the market is really looking at in terms of the outcome of this election. But whether all of this will have any bearing in terms of growth over the next 4 quarters or so, I don't think so. It's going to be the other factors like, you know, inflation, crude, interest rates, currency movements, which will decide in terms of how the corporate earnings really play out over the next 4 quarters or so.
Well, Nilesh, let's talk about that then. What about earnings growth? Last couple of years, one year we were hit by demonetization. The next year, GST did play its role. This year, at least at the start of the year, everyone's talking about 18 to 20% growth on the Nifty in terms of an EPS. Are you working with those numbers midway through the year? Do you think we'll have to scale that down? Or are you in the camp that believes that 18 to 20% is on the cards?
Well, Nigel, it probably, I think 15 to 18 seems to be a more kind of a reachable range rather than 18 to 20. I think 15 to 18 should be basically good. I think 18 to 20 would have been possible if we didn't have headwinds in terms of some of the headwinds in terms of inflation, crude oil, currency. But clearly 15 to 18% is something that even we're hoping for and betting on, and we see a very high probability of that happening. Especially because we're dealing with a low base effect because of demonetization and GST. So clearly we've gone through an era of maybe 8 to 10 years of single-digit earnings growth, and clearly FY 18-19 is, in our view, going to be the year where we are going to see a double-digit earnings growth, more likely in the range of 15 to 18%.
Okay. Well, Nilesh, I have two questions on two sectors. Do you think the Nifty is about its highs at this point in time, given the headwinds of, inflation and crude and rupee? And the mid-caps, do you think, their day is over under the sun, and 2018, it is not really safe to bet on mid-caps?
Well, it looks like that clearly the Nifty is definitely seems to be a little overstretched for the time being. We clearly believe that there is clearly a risk-on trade, a risk-off trade which is underway as far as India goes right now, and especially I think historically India clearly has been, global investors tend to really take an opposite view of India in relation to the crude oil prices. So when you have strong crude oil prices, clearly India falls a bit out of favor, and we see a risk-off trade kind of setting in as far as Indian equities go vis-a-vis global investors. And what happens in the process is that it's clearly the mid-caps which bear the brunt first. Of course, for mid-caps, we've seen a bit of more of tepid earnings, as well as some kind of restructuring and reorganization by some of the mutual funds because of regulatory reasons. So clearly mid-caps this time around have had to bear the double brunt. And then I think post that, you'll actually see some pressure even coming in the large caps as well. So our sense, our view is that I think a lot of damage on the mid-caps has already been done. It's quite possible that maybe rest of the month or maybe another 4 to 5% shave off in mid-caps is quite possible at basically the index level. And post that, what we basically see is even the Nifty coming under pressure. So our sense is that we are probably on the Nifty trading towards the top end of the range in the very short term. And clearly we believe that for the rest of the year we will see really the markets remaining relatively range bound. I think it's going to be unlikely for the Nifty to kind of make new highs or sustain there. Even if they make new highs, we believe that's going to be difficult for the Nifty to really sustain new highs, and we could probably end up with 2018 as the year of consolidation. So that's basically broadly our view, that we believe that there is still some more pain there on the mid caps, and post that we see some bit of consolidation creeping into the large cap space as well.
Okay, all right, let's get in Mitesh then into this conversation. Mitesh, what's the next trade on the Nifty? I was looking at the 50, the 100, the 200 DMA on the Nifty. That's a distance away. Even the 20 DMA is 150 points away. What would your view be on the Nifty in terms of a trade?
So, even Nigel, I think we were looking at targets close to about 10,950 over the last few days. I think that's nearly been met today. Given the fact that we've had a negative candlestick pattern, and we are kind of stretched, and as you rightly mentioned that we are slightly far away from the short to medium term averages, my sense is that we could have some consolidation. The key level on the downside is 10,750. Few days back on the intraday charts, it was a tough level to get past 10,750, 760, give and take a few points. And if we break that, then I think the 20-day average could be tested. I'm not looking at a big correction, but below 10,760, another 100, 120 points kind of decline, profit booking led kind of decline could happen. And broadly, it should be a market which should possibly, over the next few weeks, be in this broader range of 10,600, 620 to roughly about 10,900, 930 on the upside. Oh,
okay. Mitesh, Nilesh, just stay on. Let's get a macro view as well. We are being joined by Neeraj Gambhir of Nomura. Neeraj, what was your key takeaway from the way the markets behaved? Is the rupee responding to what it perceives as politically not so stable 2019? Or was the rupee's fall towards 68 some other message?
I think the bigger driver to my mind, politics is obviously an important driver at this point in time, but I'm not sure if Karnataka election results are that much of a surprise. I think the bigger driver currently is the global macro environment, especially the crude oil prices, which are currently at around $78 or $79 for the Brent. And that has very significant implications for our balance of payments. Our estimate is that at about $78 for crude oil, our BOP surplus will completely vanish and we'll just be on a very flat BOP, which basically means that our dependence on portfolio flows and FDI flows will become even higher. And currently we are in a situation where, driven by the global environment, the emerging markets are seeing some kind of a withdrawal of liquidity. So I think it's not a great backdrop, and what's happening to rupee is reflective of the fact that a widening current account deficit driven by high crude oil prices will require significant flows from outside for funding.
Okay, let me toss this to Nilesh then. Nilesh, how would your stock selection be in a macro backdrop where you are expecting earnings to grow by 15 to 18%, but you are going to see a rupee that will perhaps weaken beyond 68, and bond yields clearly looking like heading to 8%? How will your stock selection be?
Well, Tata, clearly, therefore, in the medium term, clearly exporters throw up a whole bunch of opportunities. It's like you were exporting and whenever you were exporting, you were realizing just 64 rupees to a dollar, and you're now on the verge of going to be realizing 68 rupees to a dollar, and if that further inches up to 69 or 70, you're going to actually get 10% more for every dollar of goods that you export. Now, obviously, of course, some of it you'll have to pass it on, but there's a whole lot of that which you can even retain. So clearly, one has to be now very, very constructive about some of these exporters and sectors which represent a global opportunity. We've seen some bit of technology play out, and we still believe that that's something which is going to continue to play out for some few more quarters. So that represents an excellent opportunity. Clearly, pharma has been a very, very difficult space from a pure business perspective, but we clearly believe that somewhere, the bottom in terms of their actual performance is getting in a way formed. Lupin has announced the results today, and one has to really see those results in some greater detail. But it looks like that somewhere, pharma will start offering value, and especially in an environment where you're going to get now 68 or 69 or 70 rupees to the dollar versus 64 or 65 rupees. I think a lot of margin pressures which a sector like pharma faced could in a way be compensated by this depreciation of the rupee. So we clearly believe that in this kind of an environment, probably one needs to be a little more careful, cautious, or underweight on the rate sensitives, and be more constructive and positive about some of the exporting sectors.
Okay, and I guess metals as well. I mean, Nigel was grinning when you were speaking. He follows metals very closely. I guess imported metals also will be expensive. So is that a sector? Today, those were the ones that did very well. Tata Steel, JSW, SAIL, Vedanta, Hindalco. Would that also be a sector that will willy-nilly get some benefits?
It could get some benefit, but we have to keep in mind that clearly commodities are a space which are very, very vulnerable to global developments. I mean, of course, the classic trade is that when the dollar strengthens, commodities weaken. So obviously that has not yet played out this time, but it could really play out as well. And who knows? I mean, commodity prices, especially commodities of steel and iron ore and these kind of commodities, could be down 10–15%, from where they are today. And suddenly you'll find most of these companies not growing or not delivering abnormal profits. So I think that's a very serious risk with commodities. And I think at these kind of levels, one should really not be betting on commodity stocks at all. I clearly believe that our technology and pharma are relatively better place to be versus metals, especially given the kind of move that metals have already witnessed. Maybe a contrarian bet could be also the textile space. We've seen a lot of stock prices of textile companies kind of completely battered, but they do tend to benefit with a depreciating rupee. So maybe that's probably on a relative basis a better space to be in versus being in the conventional industrial metals and commodities.
Okay.
Our market special. Political macros and petro product macros, of course, hit the markets today, and we saw the rupee at declining close to 68, and bond yields rising to almost 8%, 7.9% to be precise. We've been speaking with Neeraj Gambhir of Nomura. Neeraj, the bond markets, do you think now 8% is a given, or can it even get worse?
I think 8% certainly looks like within the sight. I don't see any change unless and until we see a substantial pullback in crude oil prices. And as a result of that, a little bit of sort of relief in the depreciation of rupee. I do feel that 8% is within sight. From there onwards, we need to see whether 8% as a level is good enough for a number of the banks and players who have been staying out of the market to come back and start sort of investing at the margin, and if they do, probably we settle down there, and from there onwards I think it could be a pretty flattish market for some time. But if they don't, and we continue to see a upward rise in the crude oil, maybe towards 80 or thereafter, I could see that we could even inch higher to maybe around 8, 10 or thereabouts. It seems like right now the bond market is trading very correlated with how the crude oil prices are doing, and given the impact that these the crude prices have on inflation, on fiscal deficit, on current account deficit, I think there is a very strong correlation between how the domestic market is trading versus the crude oil prices.
Okay, but what about the currency in that case? I mean, at 8.1, one should expect Indian bonds to be very attractive to global investors. At some point, doesn't the table turn? And what would be the equilibrium point for the rupee, you think?
Well, it's slightly difficult to make that call right now. I think there are a few things which are going on. One is that the flow of money towards EM as a whole, as a result of dollar strength, is actually reversing a bit. And that's not a great backdrop for us to see significant flow of money into India. The second thing is that, from a domestic investor standpoint, we haven't seen, I mean, I thought that levels like 7.5 or 775 would also be quite attractive for people to start investing, because at those levels, you start discounting a large amount of rate hikes, which could potentially be thought of. And therefore, from a value perspective, even those levels are quite attractive, but we haven't seen a significant amount of investor interest at those levels. So it's slightly hard to take that call right now. I think we will start seeing investor interest once the markets, stabilize a little bit more and settle down. We particularly need to see the global, commodity prices to settle down. We probably need to see a little bit of more stability in the dollar's upward move. I think these are the two preconditions to me before we could see some kind of buying interest to come back. I think we also need a little bit more clarity around the FPI regulations that have been recently, put out. There is a significant amount of, apprehension and concern around as to how these regulations will be implemented. And I think that could also be one driving factor as to why investors have actually not come back to the market in a bigger way, especially in the government bond market.
All right, Neeraj, we're out of time. Thank you very much for joining us with your thoughts on the bond market and the rupee market. Well, the conclusion really is that even as politics remains a little inconclusive as to what will happen in Karnataka, what will happen in forthcoming state elections and the general elections, there is also a sense of inconclusiveness about how things will pan out in global macros, in the way the dollar and crude parameters are moving. So a lot more perhaps pain, or at least some more pain, to come both in the money markets and maybe even equity markets. Thank you very much for watching our special Election Exchange Markets Verdict.